We're live here again. Wayne Carr, Scott Genad,
We're back, dropping gems.
the hidden gems. Awesome. Okay. So last time we talked about more of an intro to infinite banking and basically the fundamentals. Now we'll just have a conversation, talk about different topics and sections, and we'll just basically just go from there and take it where it is, where we go.
Yeah, no, I know we covered a lot last time. It's kind of like drinking from a fire hose, completely new concept, different mindset. So wanted to kind of start to zero in based on some of the things that we discussed. And if there are things that you guys want to hear about, obviously let us know and we'll take a deep dive on those. But I wanted to, Scott, because you've been in insurance specifically much longer than I have, or an adjacent industry. I came from banking to insurance, probably very similar 10 years. You were securities based. You played in that space, in that sandbox, and now in insurance as well. So I wanted to talk about this buy term, invest the rest notion and kind of talk about and debunk some of the myths around the things, the conversational narratives that are floating around in regards to that specific strategy.
Well, yeah, it's 20 plus years in the industry and I actually did start my career in Primerica. That's a funny story, but working in the mall and when you're in your teenage years, just making some cash and working one of those kiosks, the typical, back in the day, MLM marketing, go mall hopping is what we used to call it. Just
Yeah.
body professional and ask them what they do. And if they like to make some extra cash part time, right, that's how they do it. And Primerica did. They got me at 18, 19 years old. Shoot, almost, wow, a long time ago, 30 years ago. And basically it was buying term and getting a lot of death benefit for a small fraction of the cost, kind of like a rented policy, so that you can put all the extra cash that you normally would be paying for into a Roth IRA is what they were told. But then they would do those illustrations, those pamphlets that they would bring, right? Those three-way pamphlets you open up. They all look the same today as they were 30 years ago, to be honest with you. It was all about you can't lose, or you put in on some of the other, annuity style stuff. But when it comes to the Roth IRAs and the growth, they use those average returns on those pamphlets. It was 10, 12%, as if you were going to get it every year. But they look so great because that's what they're using, the average number. So it was more about buying a term policy, 15, 20, 25, 30 years, $50 a month for $500,000 of death benefit in your 20s, and then put the extra $200 or $300 a month into a Roth IRA, and then, hey, you'll be a millionaire by the time you know it. Doesn't happen that way. But do you know how Primerica first started, or who the founder was and how his story was?
I do, but I know you know it better from the inside. I think it's Mr. Williams,
Yeah,
correct?
well, that's correct, Mr. Art Williams.
Yeah.
And I don't know the whole story, but I've heard different paths of stories about something happened to his parents a long time ago. They had a whole life and just took it as the life insurance agent made tons of money on this guy, and his father passed away, and all the cash that was built into it went to the insurance company, and they just got the leftovers from their death benefit. Couldn't be further from the truth. It's just the agent didn't educate his father what he probably had, but basically came up with the idea of competition and
Hmm.
decided, I don't want to pay that much money. I'd rather just start some company, hire plenty of people into a kind of pyramid style. And then next thing you know, it'll trickle down. I'll be a multimillionaire. I go to conferences and be praised, saving people money and then putting money into Wall Street. And basically what happened was Primerica back in the day had been along with Smith Barney, Solomon Smith Barney, for their broker side of things. So they'd have term, 10, 15, 20-year term, and then they'd go ahead and partner with a brokerage account like Smith Barney and Solomon, and they'd have their Roth IRAs set up. So that's how it was. But then back in the day, they transitioned to a big company called Citigroup, right? Nice little umbrella, which is what Travelers used to have as the umbrella. And it's pretty, not contradictory, but I got the word at the moment, but it's terrible to know that banks are the largest holders of whole life, right? That they buy whole life when it comes
Right.
to banking. But Citigroup, largest banks, and partnering with Art Williams and Primerica, decided to sell you term. So they'll sell you term, even though the big banks use this stuff. Hypocrite. There he goes. How hypocritical is it that you're selling something to people that the largest bank that is acquiring you or merged together with you buys whole life instead of term? It becomes pretty hypocritical. And people don't really understand that, but they prey on this buy term, invest the rest thing because that's saving money, not understanding what whole life is actually built around for 200 years because there was no term, there was no universal, there was no IUL, there was no VUL. It was just whole life. That's all it was. And if we had it today, I think people would just have whole life. It'd just be designed differently, I think, in different aspects. But your thoughts?
Yeah, I think my biggest thing with the buy term investor rest, and you started to touch on it, is that you're renting your policy, which is probably why Art Williams and his family had whole life to begin with. And I think you hit it spot on. I guess my first question is, first of all, what type of whole life policy did they have? Because they could have very well experienced a situation where it was the same type of whole life that Dave Ramsey alludes to without acknowledging the fact that what we're talking about when we talk about infinite banking is a specifically designed type of whole life policy. So not only is it custom, but it's a different type of whole life policy altogether. So I guess that's my first question when you reference that story in that situation. And the other thing, like you said, they're renting it. And when they invest the money into the Roth and they show them this pretty projection, the money has to sit there in order for it to materialize. Even if that were possible, you can't disrupt the growth. And I mean, you could get a security based line of credit and things like that, but I don't even know. Well, I guess they're accredited they're accredited brokerages that the money is housed in. So you probably could get a security based line of credit, but that doesn't negate the fact that when you use whole life, you circumvent that necessary consistency because it's already built in. I don't know. I think everybody knows the story of the tortoise and the hare. So you can definitely prop up the Roth IRA with the 10, 12% every
Oh,
year.
yeah.
There's no average returns as the tortoise, but the tortoise never wins that race. And life is a marathon, it's not a sprint. So if you want something that you own, that you can control, that's been consistent, then infinite banking and whole life is the only thing that offers you those benefits. Not to mention that in the event that something does happen, if you deploy the buy term invest the rest for a long time, their policy didn't even have living benefits, their term policy. Now
Correct.
I think it does, but still, before you can get any subsidies from the government as far as home health care, nursing home, anything like that, they're going to make you deplete that brokerage account.
Oh,
And that
100%.
doesn't happen with insurance because it's a private asset, it's an insurance policy, and it's only an asset if you need to classify it as such. Otherwise, it's just another insurance policy with an absurd amount of benefits. And then there's the other thing that, like you said, you alluded to them mall hopping and finding their clients that way. And I've seen the presentation a few times where you get to this fork in the road is like, do you see the opportunity here? Or do you just want to continue with building the strategy? And the whole way that they get people into that funnel and that they recruit agents, it requires a certain level of discipline. And the
Oh, yeah.
people that they're even targeting for that strategy often don't have the discipline and the mind shift that it's tough enough with infinite banking in this. But when you tell somebody that they have to set aside, in addition to their savings, $300 a week into this brokerage account that's going to do this in 30 years, the likelihood of them doing that is slim to none.
We've seen that
So
also. It doesn't happen.
at all, it never happens. And
It's buy
then
term buy term spend the rest is what it is today. It's not buy term and save the rest. I'm telling you, or invest the rest. It doesn't happen that way today because things cost too much. Gas goes up. You see what the price of gas is. Food goes up. Inflation, right? We have, hopefully no war, but we don't gotta get political. But things out there in the economy are gonna definitely do things differently to money when we make it. And there's no
right,
no raises going on today in people, money that increases their income. So they're not going to save it. And plus, like you said, if that's the case, they're going to be saving it from the wages that they earn after expenses, the surplus. And when it comes to the infinite banking that we talk about, we don't want you to work harder. We want your current money to work smarter for you. We just want to redirect the money that you're giving it away and you're not earning a single penny on it. That's what we want to teach. But that would only work if two things happen. One, you have to think outside the box. That's
right.
number two, you have to be the type of person that keeps an open mind. Because if you're a closed-minded person and anything anyone tells you to try to help you, you're just going to shut down. You might have tried this before, even when you were recruiting or you're helping other agents. You can't hire an agent who comes from Primerica or tell an agent or an advisor from, PHP, GFI, WFG, or anything, trying to sway them their way because that's their closed-minded think of that's who I am. I'm Primerica. I'm
Hmm.
PUA, I'm IUL. You're not gonna get me off what I'm doing, right? I'm brainwashed into my own cult, so to speak, right? But but we use this every day personally. So it's not like we don't have these things that other people have. Like I had a term, right? I have it.
Had.
Well, I hate them, but we have these whole life, but not in the way that people think. Like you said, to Dave Ramsey's mindset, it's more of an asset. We consider these whole life like an asset, right? A modern whole life, or starting to call it like a hybrid in my mind.
Yeah.
And we can design these very differently. So I think that's where it goes back to the people just understood what we're trying to educate them on. Instead of hearing the word life insurance and thinking death benefit or expense, we want them to understand first, this is completely different than what you've ever heard or seen before or taught. That's kind of what we're trying to educate people on. But it's not going to help if you are closed minded and you can't think outside of the box, at least for a presentation. Let's just say.
Absolutely. And I think it's funny that you said buy term and spend the rest. And I wrote that down because I wanted to come back to it because it ties directly into what you said. Like, this is just cash flow management. And we're just redirecting where it goes first. And you're not giving up access to it. And when you do access it, you're not disrupting the growth. And that's also the difference between this and the that other three-letter vehicle,
Okay.
because that's set aside money. So what we're able to do, because we're not setting money aside, we're just redirecting, storing, and parking just like you would in your savings account or anywhere else. It has to go somewhere first. We're just telling you to put it here first so you can capitalize on it indefinitely. And then when you access it, you still have access to it without disrupting the growth, and you can replenish it on your own
Right.
terms. And somebody asked me the other day, who does this make sense for? And I wholeheartedly believe that every household should have it. Just like every
Right.
household has a bank account, or every household needs a roof over their head or a vehicle, every household needs a way to maximize their cash flow, because everybody's taught to pay yourself first, or they're taught, or they should be in some cases taught that your money should be the second or third income in your household, but nobody ever tells them how to do it, or the obstacles to achieve that feat are so, I don't want to say far-fetched because it's easily accessible, but because it's so nuanced and almost a foreign language, they shy away from it out of the fear of being thought of as less than, when all you really have to do is get a properly structured insurance policy and it checks all those boxes. And
Yep.
then as you get more familiar with the process, you can branch out from there into those other vehicles that maybe were intimidating before, but now because you're now in the room, you feel a little more comfortable looking around and having those conversations.
Correct. And to touch on what you mentioned before, we all put our money in a bank. And it's funny because we don't remember. I mean, I do 25 years ago when I was working, we were handed a check. We didn't have
Yep.
direct deposit. You
Right.
had a physical check handed to you, right, that Friday,
Right.
and you better get your ass in that car because you had one of two different options that day because it was Friday night. You were either going to deposit it or you were going to cash some out.
Yeah.
That's the only thing you do. So when they say don't put all your eggs in one basket, I don't truly believe that, to be honest. I mean, we put all of our eggs in one basket first. It goes to the bank. Before we get a car to pay bills or electricity or groceries or anything or invest, it has to reside somewhere first, which is a bank. So yeah, you are giving the bank all of your eggs. The difference is we can't put all of our eggs into life insurance policy because it's not a bank, right? So it's an asset. So we first have to put our money in a bank because that's what the standard is today. But then we can then shift some of the money out into a different asset first that we have. Then we can borrow it back out or percentage of it back out to go use it for investing in a Roth IRA. Now our money's working in two places. Go out there and then buy a piece of property and have other people rent it like an Airbnb, and their rent pays all the loans back to the bank, right? For the mortgage,
Yeah.
the loans to the insurance company, and having our money work in three or four ways now with appreciation. So people have
Hmm.
no clue what you can do with a structurally whole life policy, not a traditional whole life, nothing universal, and definitely not a term, right? I don't even think you even need a term because the way we design these infinite banking policies with whole life, we have a way where people don't know we have a term policy built inside of the chassis as an optional rider. So we are paying for a term inside of a whole life, and that's how we build infinite banking in a structurally whole life policy. So that's how you see it's very different that people like Dave Ramsey's or the money guys or these IUL people or Primerica, they have no clue, right? And if they did, they still wouldn't budge because their heart is set on what they do. which is that industry, right? Term. Right? They won't change. They just won't change. Or commission, you know that, right? I know a $6,000 premium for a whole life. An agent perspective might get paid 2,500, but from an IUL perspective, they might get paid 7,000 on the same six.
Right.
What do you think an agent's going to do? See, you and I come from a different cloth of ethics, right, and integrity, where we would rather the client,
Shots fired.
right? So not somebody else. We
Yeah,
consider the client, right, a relationship, not a transaction like their car salesman. So that's kind of what I
absolutely.
think you and I, we have a good connection that way, I think.
Now you said a lot of things that I've shied away from, and named some names that I've kind of shied away from too, because it really does come down to integrity and the fact that they don't know what they're doing in a lot of cases. They're regurgitating information that they don't understand, and shame on their mentors because somewhere up the line somebody knew
Yeah,
and they decided that the bag was more important than the human on the other side of the table. And I just don't operate from the other side of the table. I need you to understand so that when you come across one of those people, you can say, no, that doesn't make any sense. This is what I have. But you said something in regards to the term policy, and it ties back into the Art Williams situation where we attached a term and they were frustrated because, and the same buy term invest the rest people say that as well. And I also want to touch on the fact that they say, why would I borrow my own money? We're going to go back to
go on,
that too,
go on,
because
go on.
I love the way that you explain that. But they also say what you just said about what happens when you pass away. The insurance company is keeping all of your money and you're left with just this death benefit when in fact the way that it's structured, because it is a specially designed type of whole life policy, the term rider is attached to it to allow you to put the excess capital in the policy in the first place to accelerate the growth and for you to access your cash and manage your cash flow. And that actually drives up the amount of insurance that you have. So, I mean, the PUAs are paid up additions,
Yeah,
additional units of insurance. So as you add money, you're literally buying additional insurance. So a lot of times people say, well, when you pass away, you don't get the cash value and the death benefit, but you do because the cash value is baked into the death benefit. And that's just I guess a real life case of people what is it called? Just people talking ill about things that they don't understand instead of asking the questions.
maybe you don't want to use the word, but I'll use it. They're ignorant.
Yeah, absolutely.
Um,
Absolutely.
because you did touch on it. Like, what do you mean I don't get both the cash that I put in and the death? Well, let me explain. If you put in over years of this account that we make room for you, $100,000 is in the cash value, but your death benefit is 400,000 if you passed, right? Let's say it's a catastrophe. Well, the insurance company keeps your 100,000, they still pay you out the 400. So really, they'll say the insurance company is only on the hook for 300 because they have my money. But without taking into account if you actually used it and your agent, right, explained it to you, that's the problem that Art Williams, I think his family has. No one explained to him. They were on the country clubs playing golf all day. They weren't
Right.
explaining these things to their clients, doing reviews with their clients. They just sold it and left them. Put it
Yeah.
into your drawer, and now they died and have all this money they didn't even know they can use, or they didn't even know they can stop paying and let the whole cash drain it out till death without putting a single dollar in. That's a whole nother topic. But the whole point is this:
Yeah.
if I used it and I educate my clients and they bought properties, they paid off their cars, they have no debt. Well, guess what? If they still have $100,000 of your money that they gave you 400,000, you still have all those assets, don't you? You're still done with debt, aren't you? So if you use it effectively, they can keep my cash and give me the death benefit tax free. I still have all the assets and the debts I paid off. That's what a lot of people don't see outside of that. They just see one picture. There's no gray areas, black or white. That's it.
Yeah. Not to mention that, but just to break that 100,000, 400,000 apart, like if they're putting $100,000 into a policy, then their premium was likely $10,000, which probably actually bought 70, $80,000 worth of insurance. And that other $90,000 went to buying the other $300,000 worth of insurance that they now have. So yeah, you started with this, and when you added the other 90, it inflated the amount of insurance that you have. So now you have this amount. So no, you're not getting the cash value and the amount of insurance. But if you did really want that and push for it, I'm sure they would willingly give you the 70 or $80,000 that the 10,000 bought to start and your 90,000 back instead of the 400,000,
Yeah.
because that's even more lucrative from them. And they already are the strongest financial industries in the country because it makes so much sense. And the margins are thin
They
to
are.
begin with. Not like the IUL. The margins are thin to begin with. It's for them, it's a volume play. And this is why banks buy them in volume,
Yeah.
because for them, it's a volume play and a way for them to grow their money consistently without disrupting the growth so that they can sell it to everybody else that subscribe to the buy term invest the rest, that are perpetuating the fractional lending
Yep. Yep.
narrative.
And we'll touch on that because I think that's a good thing to touch on and explain to people what is fractional reserve banking so that
Yeah.
they do understand. I mean, we can hit that right now and then we can come back to the why I borrow my own money kind of talk.
Yeah.
This is
No, you
pretty.
can't. Absolutely.
Um,
Absolutely.
what people don't understand is I talked to a couple people, it's business owners as well, that are sitting on a lot of cash. And even one of my wife's friends that was sold property, has some cash in the bank, whether it's 50, 60, whatever $1,000 just sitting there, they like it for emergency because it makes them feel comfortable, right? They like that comfort, right?
Hmm.
I feel like I'll have it's emergency if I need it. But the problem is if you ever needed a loan for 30 grand, 40 grand for a new car, and you go to
Jump
your
through
own bank,
hoops.
they're just giving you your own money back.
Literally.
They're lending you your own money back at 6 or 7% these days, if you're lucky in this interest rate environment. You're getting less than 1% in your checking or savings account of these major banks, right? Not the credit unions that probably still give 2 or 3%, maybe. But now you're paying them on the money that was yours.
Right.
They get the spread. So that's basically what? Waste of your cash? Money?
Literally what the buy term investor as people are talking down on and telling you to go do. But go
Yeah.
ahead.
It's pretty funny. But for people to understand, when we get paid, we give the banks deposits, our money. Now the bank has money. Banks don't have money. They wait for us to give them money. We lend the banks our money. We're lending them money at 0%. We're just giving it to them. Okay? Then the banks have our money where they can lend out 90. I think they only have to keep 10% now.
Yeah.
Okay? So
10% on hand.
90% of our cash that we lent the bank goes out to multiple different people that they can now charge 6, 7, 8% or 25% on credit cards with our cash.
Absolutely.
And we get less than 1%. And even if you do get 2 or 3%, the banks are charging 7, 8, 9. They're making 500 to 1,300% percent on a sweat backbone and labor of what we do. They do nothing. We do it all for them. And then they want to give us less. So that's what fractional reserve banking is. It's basically just giving away our money, letting them lend it out, and now they're getting the spread.
And we can switch gears, but just to, and the interest that they give you, they're going to 1099 you for it as well.
Oh
So
yeah,
you're going to pay taxes on that, as opposed to leveraging infinite banking. It grows tax free, compound dividends.
that's true.
So
That's true.
you'll
That's
never
why
pay
you and I,
taxes on the growth.
why you and I don't do that. We deploy our money somewhere else when we get it. We put it back in our account as a loan tax free, and we'll get into because everyone always asks me whenever I do that, what's the loan rate at what that you're borrowing the money of the insurance company? Well, it's crazy how people think, right? Because not to get off topic, but I can show someone because I show all my clients, my even prospects, my personal portfolio in the policies. I have four
Hmm.
that I've borrowed from, haven't made payments back because there's a lot of things to talk about. No credit checks, no background checks, no waiting in line. Money comes back direct deposit within 7 days or less, and I get to make the payment plan whenever I want to because we're playing by a different asset.
Hmm.
These are financial loans. These are insurance loans, which now we're playing by different rules that people have no clue what we're doing with. But even when I show people my transparency of all the stuff that I've borrowed, and I've still earned like $12,000 this year on one of my policies of dividends, they still ask me what the loan rate is. And I just told them I just made $12,000 of a dividend, tax free, on money I owe somebody else. But all you want to know about is what's the loan rate. You see what I mean?
Yeah. It's
That's the same.
focused on the wrong thing.
We're focusing on the wrong thing because society has trained us to focus on interest, growth, arbitrage, spread. What are you earning? What are you growing? They never teach us how to build money inside of an asset like real estate that we can borrow a line of credit and now go ahead and make money on top of money and still earn on the same dollar.
It's funny. I had a client
Great.
that was buying a house recently, and she borrowed from her policy to put the down payment on her house.
Yeah.
And the underwriter said, "Well, you can't do that because now you have an out, it messes up your DTI. And she went back and forth. At first, I spoon fed her the information to give to the underwriter initially. And for some reason, it just wasn't registering. So it shows you how ignorant society is
Yeah.
about this concept that's been hiding in plain sight forever. So finally, we had to get on the phone and I explained just that. It's a private loan that she never has to pay back. And in the event that she does decide to pay it back, she completely controls the payment amount, the payment date. So there's no structure that says she ever has to put this back. So it
Cool.
doesn't mess up her DTI. It's not going to disrupt her ability to maintain her mortgage. As long as she maintains the premium, she's fine, which also doesn't happen in that other vehicle because the rising cost of insurance
Yep. Yep.
dictates
Let's
how
walk
much
on
of
that.
your premium actually goes towards that cost of insurance. And if it's not performing, you could end up, just imagine running on a treadmill at 7 for 3 miles. And then all of a sudden, mile 4, you decide you run at the pace of 5. You fall on your face, right?
Oh,
It's the same thing that happens to your dollars.
yeah. And so people understand debt to income is what Wayne was talking about.
Oh, yeah. I said
Percent.
DTI. Yeah. No, absolutely.
Yeah,
Absolutely.
because we gotta understand when we're talking to everybody, but we're also talking to that one person who may or may not know PUA, paid up additions, DTI, like Wayne's talking about debt to income. And we're gonna throw out some narratives and some other different words that might not make sense to you and some might understand, but just let us know anyway in any comments.
Yeah. In the comments or find us on our socials. Wayne runs, Scott's IG,
Yeah.
Scott Genad,
Yeah.
or
Um,
be your, what is it?
Me do what banks do.
Yeah, do what banks do.
Yeah.
It's usually in the background, so I always cheat. But yeah, just DM us and ask that question. But before we get out of here, and I don't know what else you have. I want to go back to that borrowing narrative
Yes.
where the buy term invest the rest people, which you've so eloquently identified as Primerica, where they say things like, "Why would I borrow my own money? That's stupid. That doesn't make any
Yeah.
sense." And again, it's just a lack of understanding of the way the product works and the ability to focus on standing your product up, regardless of what else might be out there, and just not educating yourself. So talk a little bit about like how that is just couldn't be further from the truth.
People always ask me, why would I want to borrow my own money? Or why would I want to borrow something, right, for myself? I have the cash. Usually people who say that they have cash is usually what I have 30,000, I have 10,000. Why do I borrow money? I have the money. And the reason is this. If you have $10,000 and you spend 7,000 for something, well, you don't have the 7,000 anymore, do you? No. And you're not earning any interest on that money either now. It's gone, right? So now you lose the opportunity cost that your money could be earning interest somewhere else at the same time. So if I borrow money from an insurance policy that we have, and let's say we're borrowing the same 7,000, what if I told you I'm still earning 4, 5, or 6% on the same 7,000 that I just borrowed? Even after taking the 7,000 and going ahead and buying or opening a custodial Roth IRA at Schwab or Fidelity. Isn't that cool to know that I can borrow money from my policy, earn 4 or 5% on the same dollars I borrow, go open a Roth IRA and dump in 7,000. Now I have tax deferred growth, tax free distribution and later in life. And now my money's working in two places at once. Wait, but don't you have a loan to pay back? Well, I do and I don't, because now it's not a financial loan, it's a life insurance loan. So we qualify more so with our health, not so much our finances. So a life insurance policy comes with a death benefit. And that, my friends, is what we call collateral. And we can use a real estate as collateral as well, which I'll touch up for like a similarity. So basically, when we get life insurance, we pay a premium. You might think of it as an expense because that's what Dave Ramsey and all his disciples tell you about, or Art Williams about expenses. You're paying a lot of money. But I'd rather pay money every month to a deposit that I put money into, other than a 401k or qualified account or a savings account that I earn nothing on. And then I can deploy more cash, like into a savings account at the bank, but in a policy. So I'm basically building my own line of credit, my own equity inside of another asset that happens to have a death benefit that when I die is like 10 to 20 times the amount of money I put in. So if I borrowed $7,000 and I passed away from a catastrophe, well, guess what? Now, if I had $200,000 of a death benefit, they subtract the 7,000 and my wife gets 193 tax free. Oh, and by the way, I still have the Roth IRA, don't I? That's correct. So you see how we don't have to pay it back. There's no loans. that we have to pay back. Now you should, because if you own your own bank, why don't you want to pay yourself back, right? Because if you spend $7,000 to open up a Roth IRA for that item, would you have to start working, pay bills, and then replenish 2, 3, 400 bucks a month to replenish your 7,000 you just gave away? So why not do the same replenishment, but just call it paying back a loan?
Right.
Same thing you're doing. You're doing the same exact thing. Okay. The thing is, we're just changing our mentality, our methods of how we do these things. That's it. We're just changing the words. And then everyone asks me about the interest rate. You ever ask you that when you're telling them, hey, I take a loan, but they ask you, Wayne,
Always.
the loan rate,
Yep.
right?
What's the loan rate versus what's the dividend?
Yeah.
And
Yeah.
it,
What's
and
the
it's
dividends?
articulated perfectly in the example you just gave, the 10,000, 7,000. But go ahead.
Like, well, I always ask people when they ask me, what's the loan rate? You know me, I always like to ask questions with a question. I'll give you the
Right.
interest rate, but I want to know how you're thinking first. So I usually compare it to credit cards, because the majority of people today, we use credit cards. We don't have coins and cash that much in our pockets anymore. So if you have 2,000, 3,000, 10,000, whatever on a credit card, is your Visa card charging you 23% interest? Okay. Oh, would you rather have, let's say, 6 or 7, 23, 24? Yeah. Okay. Well, that's one benefit. But better yet, even if you have a 0% 18 months, you're not paying the interest rate on those intro credit cards, 0% 18. But guess what? You're giving away cash. You have to pay interest, but you're giving it away. I'd rather pay money on a 6 or 7 interest rate on a loan I take, because I'm also earning dividends at 4, 5, or 6% at the same time.
Absolutely.
So why would I want to do that versus just giving away money when I can pay it the same way at a lower interest rate? I mean, that just makes more sense. I don't get why people do that. But they're always thinking about interest rates. Interest rates. What's the interest rate? What they charge me? I don't know. Are you earning anything on your Visa right now that you owe $3,000? Well, what if Visa? And I've been doing this recently. I asked people, what if Visa next month in June comes out with a program that says we have this new 30-day program, and we're going to just give you 4% on the 10,000 you owe us, but we're still charging you 23. But would you like us to give you a free 4 or 5% on your money you owe us? Yeah, great. Will they do it? No. But now I'm telling you that this company does do it, but you don't believe it. And Wayne, I'm telling you, as I sit here today on our podcast, I show people my physical accounts, and I show them how much money I owe, and I show them the dividends that I receive, and I show them that I haven't paid them back in like 2 or 3 months, because I forget sometimes, because we don't get a bill. We don't get,
Right.
it's not a bill, right? I get a notice every year, but it's not a bill that says you got to pay it, right? So it's like, even when I show people that, they still don't do it. And do you know why they don't do it?
They're just indoctrinated into the system. It's too good to be true, but it's
They're-
been tried and true for centuries.
Number one reason, when I dig deeper, right, from that peeling that onion from my client, I tell them, just be honest with me, because you're obviously not going to do it. But just tell me, did someone talk to you? Did you talk to someone? Yeah, well, I talked to my guy, my broker, my advisor, my dad, my friend, my neighbor, my cousin, my life insurance agent, this other guy. So you're having other people affect your judgment instead of showing that someone's proof, right? Transparency. I'm showing you I have it, but you want to find reasons not to do it by asking other people that have no clue, that you think are specialists, that manage $500 million under management at a bank that their second grandfather used to have relationships with,
Yeah.
but they won't believe the truth.
Seek and you shall find.
So that's the whole point. You have to be open-minded, and you have to think outside the box. Traditional ways are going to keep you in the traditional manner. You might have a lot of money if you make money and you save and you spend that way without debt. But I'm telling you, you'll be better off in this for your family and your estate, rather than what what you're currently doing right now, to be honest with you.
Yeah, and in most cases, when people speak ill about things like this in this manner and with the pace and at the pace that they do, it's because it contradicts or disrupts something that's exponentially more beneficial to them. And in this case, with the IUL, with those financial advisors, like it just goes against their income model. Flat out.
Yeah.
They don't have an income model where they get paid once and then get small residuals as you use the policy. They get assets under management over time, or the IUL, they get this lump sum that's typically anywhere from 6 to 8 times what they would get if they put you in the proper product. Because when you say, I want the policy that I can borrow from, that I can store money in, you're not talking about, the IUL is new. That came out in 97. That didn't even exist when they reference the things that they reference when they're
Yeah.
selling it to you, like the JCPenney, the McDonald's, the Disney. They weren't using that because it didn't exist flat out. So that's a red flag right there. but people tend to talk down on what they don't understand or what doesn't serve them, as opposed to just being honest. I mean, I have plenty of clients like, this isn't for you. If that's what you're looking for, then you probably do need the Roth and the security based line of credit. But this is also a way for you to harvest your gains and realize those gains, so they're no longer just paper gains. You can realize them and put them right back and multiply your legacy, because now you have a tax free death benefit that's going to go directly to them, which your Roth doesn't unless you have a properly structured trust, because a will's not going to do it.
It's not. It's if you want to grow generational wealth, first the parents should have it because we should outlive our children. I'm sorry, yeah. So, but that's the only way to create real generational wealth if that's what you want for your estate. The one thing that I think most people are going to hear some of this stuff going forward is when I pay $200, $300, $400 or $500 a month, because that's what they're going to ask for. How much does this stuff cost? It sounds good, but how much is it going to cost? Well, because I can buy a term policy, like you mentioned before, for $100 for $250,000 and go invest the $200 or $400 in my 401k. I don't have to open up a Roth IRA. I can just go ahead and get a term policy and just give more of my percentage to the company match, the free money, they say, right? That free money. So I got my private insurance here for 30 years. So if I'm 30 or 40 years old, right, like I'm good till 70, but that's like if I'm renting a policy, hopefully I still have enough. But then I'm going to put the $400 and I'm going to match it because they give me, 6% match or dollar for dollar, whatever it is, the free money. And the problem is everyone sees their retirement account, their 401k, their qualified money as free money or retirement. I see that today as an expense, like life insurance. You think of life insurance as an expense. Wayne and I think of our life insurance premiums as deposits. Just like you think your $300 or $400 a month or $200 per pay period going to your 401k is retirement. The keys are this: you might get your retirement one day, but you're not getting it today. You're not leveraging your money today, and it's qualified, so it's taxes and potential penalties, and you can lose your money. So keep giving away your $500, $1,000 or maxing out your 401k because you can write some off if you need to as a high income earner, but you're not using it. You're letting it sit there and let the worms eat it or the market eat it. When you lose 20 or 30%, like 9/11 or 08, COVID and whatever's about to come.
Yeah, talk to the people that were planning retirement around '08 or going into COVID and what they had to do, what adjustments they had to make.
Yeah. I had clients then. They're working. They had to work 5 to 7 more years to recoup what they lost. And then what they did when they got their $2 million back total, let's just say, right? And now they're in their 70s or late 70s. Now they're older. And now they have to take required minimum distributions. Now they have to live off that income to a significant degree. So the problem
And
with
pay
that,
taxes on it.
yeah, pay taxes on it and probably boost them up to a higher tax bracket when people think they're in a lower tax bracket, which I know a lot of these agents today are trying to do these Roth conversions, right? Taking their IRAs now and they're converting their IRAs to Roth IRAs and they're paying all the taxes out of their IRAs for them. And like, that's the worst thing. That's not really what a Roth conversion is anyway, which we're not going to touch on that today. But the whole conversation is stop thinking about life insurance or whole life in particular. When Wayne and I talk about it, we talk about whole life as an expense. I'll happily pay $300 or $400 a month into an asset like a retirement account that I can overfund 10, 20, 30,000 extra into my savings account like it would be Bank of America. So if you want to think about it, it's almost like you're paying $400 instead of your employer contribution match. You're paying the $400 a month into a life insurance asset that you own and control, not Wall Street. And then the extra 10, 20, $30,000 every year, if you can do that, instead of giving it to Bank of America in your savings account, you now put that on top of your asset in your policy that
Right.
now will earn dividends and interest, basically 99.9% guaranteed, 99% that you're going to earn dividends because these companies that Wayne and I work with have never missed giving us a dividend 4, 5, 6% for the last 120 plus years straight through any recession you could think of. Right? World War
Yeah.
I, II, Vietnam, Cold War, 9/11, COVID, doesn't matter. We got paid a dividend. And whatever happens to the economy going forward from this day forward, Wayne and I are still going to earn dividends on all of our policies for us and our children without exception. It's going to happen because everybody has. But keep putting your money in 401ks and go through these trials and truths and ups and downs. But we'll keep using our cash while we're growing, leveraging, paying off debt, buying cars, right?
Not to mention that, I'll close with this. Like you said, $300, $400 a month, and we see them as deposits. But if it's structured properly, in all actuality, and we'll get into some illustrations at some point, but you only have to do it for 3 or 4 years, because after that, the dividend, if you fund it properly and we structure it properly, which always do because we operate from a place of integrity, in year 3 or 4, your dividend is going to eclipse your premium. So from that point on, you're getting a cash on cash return where you're putting it in and they're getting it right back to you.
No,
So you're only paying for it for 3 or 4 years. And then for the rest of your life, it's just an exercise in not futility, but I know you understand that expression. So it's just a habit that you're doing, but it's a habit that benefits you exponentially because now you're earning dividends on it too.
it's crazy to tell you that in my 5th year coming on that policy that I mentioned that I got 12,000 of the dividend
Hmm.
premium is 12,000
Yep.
a month. So next year going forward on my dividends of all the cash I put in year 5 coming in December of 2026, that dividend might actually be closer to like 15,000. And if
Yeah.
that comes to 15,000 in that one given year, in year 5, when I pay 12 and they give me 15, I mean, I'm not a rocket scientist, but even 20% return on $12,000 is like 2,400.
And that's without the PUA. That's just paying the premium. That's without adding the paid up additions, the additional
Correct.
cash.
Because all the PUA has been built into my policy over those 4 years, so I'm getting
Yeah.
dividends on all of it, not the 12,000. But it's crazy to know that in one given year, I give someone $12,000, and now they're gonna give me 15,000 after all expenses paid, cost of insurance, all of it, mortality, dividends included, all of it. Boom. That's like a 20+% return in one given year. You go show me a qualified account that you can put money in without taxes, penalty, liability, or risk that you can put in 12,000 and get 15 after expenses for 20% ROI. With
Yeah.
that, yeah, you show me your IRA, your 401k, your Roth. You show me that, right? And you're not even using it. And I've been using this policy. I've probably taken out like almost close to 100 loans through all of my policies, my child's policy, my wife's policy, me. I mean, but you guys keep doing what
Yeah.
keep doing your thing, right?
Somebody asked me, how often can you do it? Like, how I probably take out a loan almost on a weekly basis, if not, bare minimum multiple times a month, because I put a credit card in front of everything. So,
The
and what I typically respond with is, how often can you go to the ATM?
Gosh, yeah. The only difference between going to the ATM at a brick and mortar bank, right? 30 seconds or a policy is 7 days or less. That's the only way we have to wait. So if you have to pay so it's just anything. What can you use this for? If you want to pay your taxes this year, you can use it. If you want your business to fund these and then write some of the expenses off that you use for the business, right? The purchases, not the premiums. We can show you how to do that. You want to buy a
Hmm.
car? I mean, heck, I must have paid off 11 credit cards within those 5 years of this policy, and now we
Yeah,
keep racking it back up, but we keep using them, right? And then we pay them off. So Wayne and I will teach you how to wipe out all the debts if you have debts, and if you're business owners, we'll show you how to leverage the cash reserves you have in your account because you don't want to pay yourselves to pay taxes. We can show you how to leverage that cash in other places to go ahead and write it off and have your money work in two, three, four places in one, right?
absolutely.
A lot of things, children policies, and we get the generation going. We can show you that for $100 a month, just to start dipping your toe in the water is what I think Wayne and I would like you to do is one, think outside the box, two, be an open-minded person, and three, just start dipping your toe in the water on something very small and painless and let us show you over time. You'll build that trust with us.
Yeah.
We'll show
So,
you the
I
way.
mean, it really just comes down to like do what banks do and the hidden gems that are hidden in plain sight. So you can find again, Wayne runs do what banks do on all the social platforms. You have any questions, feel
Yeah,
free to reach out directly, comment, and we'll adjust accordingly.
definitely.
Appreciate you joining us.
Let us know what you guys would like to hear. What questions do you have, right, that you've heard from yourself, your thoughts, and that'll help us create more content for you and what the viewer wants, not what we want. So appreciate y'all.
Absolutely. Thanks for jumping on, Scott.
Definitely. You too, man.